Welcome back. Is Fintech flagging or looking to fly high again? Wells Fargo is calling the downturn in Fintech stocks a great time to buy names trading at a discount. But some of those tickers are still struggling to stay afloat. Let's take a look at the Fintech space with Jeff Cantwell, Wells Fargo Managing Director. Jeff, good to see you here this morning. So this entire space, along with tech more broadly, has really been battered year to date for various macroeconomic happenings. Of course, the rise in yields, tech stocks don't like that. Why are you saying now is the right time to buy?
Well, first of all, thanks for having me. When we look at the fintech space right now, the fundamentals look solid. They look strong. We think companies that we launched coverage on, they're leaders in the space. And generally speaking, they're driving three key trends that we think are sustainable, which are digitization, modernization, and many of them are focused on consolidating vendors for their customers, which are businesses and consumers. So overall, right now, we still see a strong environment out there. I think that the companies have put out, pretty upbeat guidance for this year. And overall, those trends that we're looking at and, that have been driving the space are likely to sustain. They're not going anywhere. So right now, based on where the valuations are in the space, we think it's a good time to be looking at fintech. And there's a number of companies that, again, are leaders in this space that we think are undervalued at this time.
Jeff, in your note, you talked about 5 themes that will matter most to fintech over the next decade. And one of those was fintech as a service. What do you mean by this, if you could expand a little bit more? And which companies do you think are best positioned to capitalize on that growth dimension?
Sure, absolutely. So when we look at the trends of digitization, modernization, and consolidation, there's 5 companies, really. Bill.com, Block, Flywire, Shopify, and Toast. And what they're doing right now is they're thinking really critically about the businesses that they're serving. And they're realizing that as they're digitizing and as they're helping to modernize them, one of the biggest things that they can do that really adds value right here is help consolidate vendor relationships. And what that means is providing not only payments or not only software, but also value-added services. And so if you look at a Bill.com, for example, what it's done quite well, in our opinion, is focused on software and then built around that. So their small business customers that they're serving oftentimes need not just the software subscription that helps them manage their business, but also a payments piece as well that helps them pay their vendors and help them run their operations more fluidly. Block is a great example as well. Block has built a very strong physical point of sale platform, and then over time they've kind of supplemented that with online services such as Weebly, which is now Square Online, invoices, payroll, and so forth. So those are the types of trends that we think are sustainable. Those are the types of trends that we think will be in demand from businesses as we look out over time. So again, we have a nice entry point right now. We think that these stocks are undervalued, frankly, and as they grow and as they continue to expand with their businesses, that will be what drives the stocks ahead.
Jeff, on Block, let's stay on that name because Jack Dorsey is still leading that company. He's still on the board of Twitter for a little while longer. How concerned are you that this debacle over at Twitter with Elon Musk just diverts a lot of his attention away from what Block is trying to do and impacts their business?
Certainly gets a lot of attention. It's a great question. Our view is, Jack Dorsey is focusing more and more on Block over time, right? And so that's a good thing for Block. I think right now where the company is in a good spot. The Square business, which has been their merchant-facing business, ultimately, is coming out of this pandemic looking stronger than it was before going into the pandemic. We show that in the data that we can see for traffic to squareup.com. We look at that closely. And what we're noticing is it was at a certain level going into the pandemic, and then it bottomed right during the lockdowns of early 2020. And then coming out of the pandemic, that traffic strengthened and it looks much stronger and on a sustainable kind of higher level at this point. So, frankly, with him focusing more time on Block and more time, on that side of the business, it should, help those trends kind of sustain themselves. Cash App, again, is in good shape, frankly. Obviously there's been a big boost from Bitcoin and so forth, but they're also focusing a lot more on monetization away from that, in terms of other value-added services. So we think that there's two tailwinds behind that company right now. And frankly, with Jack, looking more at that side of his of his two tweet ecosystems between Twitter and Block. It should be a good thing. And then overall, we also think that as he's doing that, frankly, he'll have more time to focus on Bitcoin, crypto. And so again, we're positive on that trend as well. So I think that the company should be in good shape going forward.
Another stock you cover in this space is Shopify, and that company announced today it was planning a 10-for-1 stock split, but also approval for a founder share that would give the CEO a 40% voting power. How should investors be thinking about this move?
Well, I mean, typically speaking, just looking across this space, stock splits are retail friendly, right? When we think about Shopify, what we're looking at right now is what type of growth can they get on the other side of this vaccine, right? We had a hyper growth phase for them during the pandemic, and right now they're kind of coming off of that. But overall, the company still looks strong. I think ultimately those are more market dynamics. We tend to focus on the fundamentals, and I think fundamentally the company remains in good shape. What we're seeing again in the data is a number of merchants are coming to the platform even as we come out on the other side of the pandemic. So I think that overall, where this company is right now is in good shape. We think they can grow north of 30%. That's revenue this year and next year, which at these levels looks attractive. Again, I think that they're another company that's a leader in the space, and overall, we remain positive on fundamentals.
Jeff Cantwell, Wells Fargo Managing Director, with a bullish call on the fintech space. Have a good rest of the week.